In recent years, thousands of everyday investors joined online stock groups believing they had found early opportunities, but many walked away with heavy losses within hours. These groups operated through messaging apps where certain stocks were promoted as next big moves before most people even understood what they were buying. Prices began rising quickly, and early buyers saw gains, which convinced others to enter without questioning why the movement was happening. Some investors moved savings into these trades, expecting the momentum to continue as more people joined the buying activity. Behind the scenes, the same groups coordinating the buying were also planning when to sell, long before most participants realized what was happening. At a certain point, the selling began, and prices dropped just as quickly as they had risen, leaving late buyers unable to exit without losses. In multiple cases, these coordinated moves affected thousands of participants, with significant financial damage reported across retail investors. What looked like a shared investment opportunity was actually a scam, where trust and timing were used to create demand before it was suddenly removed. What followed became visible around 2020 across online trading communities, where coordinated stock groups on platforms like Telegram and Discord began influencing buying activity in small-cap stocks. In the United States and other markets, regulators later identified cases where organized groups promoted specific shares while planning exits in advance. Thousands of retail investors participated in these groups, and combined losses reached into millions as prices rose and collapsed within short periods. In some cases reviewed by authorities, such as the U.S. Securities and Exchange Commission, individuals were charged for coordinating pump-and-dump activity through online channels. These groups presented themselves as communities sharing insights, and members believed they were acting on early information rather than coordinated signals. Stock selections were often low-volume companies, where smaller amounts of capital could move prices quickly and attract attention. Investors relied on visible price increases and group discussions, assuming that momentum reflected real demand or underlying value. This environment allowed the scam to take hold, where coordinated buying created artificial demand before most participants understood who controlled the outcome. As more people joined these groups, the opportunity took shape around coordinated buying events, where members were told exactly when to enter specific stocks. Organizers built credibility by sharing past wins, and new members trusted the system after seeing screenshots of rapid gains from earlier trades. A typical setup involved announcing a stock shortly before a planned surge, creating urgency that pushed participants to buy quickly without analysis. Money flowed into these stocks within minutes, and prices moved sharply upward due to concentrated demand from the group. Early participants saw gains, which reinforced trust and encouraged others to commit larger amounts in future events. Decisions escalated as members began allocating savings and following group instructions without questioning the source of the recommendations. The opportunity depended on timing, where those entering early benefited from price movement, while later participants relied on continued demand. This setup allowed the scam to grow, where coordinated signals replaced independent decision-making across thousands of investors. As these events repeated, the scam worked through a simple but controlled mechanism, where organizers accumulated shares before announcing the stock to the group. Once the signal was released, thousands of members rushed to buy, pushing the price up within minutes due to sudden demand. Charts began showing rapid gains, and this visible movement convinced more participants that the opportunity was legitimate. Behind the scenes, organizers were already preparing exit positions, waiting for peak demand created by the group itself. At a certain point, they began selling into that demand, offloading large positions while buyers were still entering. This shift was not visible to most participants, who continued buying based on price momentum and group messages. As selling pressure increased, the price reversed sharply, and liquidity disappeared for those trying to exit late. This mechanism allowed the scam to function repeatedly, where demand was created first and removed just as quickly, leaving late participants with losses. As more participants joined, these stock groups expanded across multiple channels, and similar setups began appearing in different markets and time zones. Some groups grew to tens of thousands of members, increasing the ability to move prices with coordinated activity in low-volume stocks. Reports from enforcement actions indicated that combined losses reached into the millions, affecting a wide range of retail investors. Organizers repeated the same process with different stocks, maintaining interest by highlighting past gains and promoting new opportunities. Decisions escalated as members trusted the pattern, committed larger funds, and followed instructions more closely with each event. At this stage, the system depended on constant participation, where new buyers were needed to sustain price movement. The point of no return was reached when group size and expectations grew beyond what individual trades could support without collapse. This phase allowed the scam to scale, where repeated cycles of buying and selling created the illusion of consistent opportunity. As more participants compared results, patterns began to emerge where the same accounts consistently exited early while others absorbed losses. Some members noticed that stock names were released only moments before price spikes, leaving little time for independent decision-making. Price charts showed sharp rises followed by equally rapid declines, repeating across different stocks promoted by the same groups. Attempts to question the process were often dismissed within the groups, and critical discussions were limited or removed. Late buyers reported difficulty selling shares at expected prices as liquidity dropped once early sellers exited positions. Independent observers began identifying similarities between these events and known pump-and-dump schemes. Trust within the groups started to weaken as more participants realized that outcomes were not evenly distributed. These warning signs revealed that timing and control, not investment value, were determining who profited and who absorbed losses. As losses increased, patterns in these trades drew attention from market analysts, who began tracking repeated spikes followed by rapid declines across the same types of stocks. Investigators and regulators analyzed trading data and identified coordinated buying activity linked to specific online groups operating through messaging platforms. In cases reviewed by authorities such as the U.S. Securities and Exchange Commission, Individuals were charged for organizing pump and dump schemes that targeted retail investors. Evidence showed that organizers accumulated shares before public signals and exited positions while group members continued buying. Public warnings were issued as regulators highlighted the risks of coordinated trading groups and the lack of transparency behind these signals. Confidence collapsed as more participants recognized the structure, and many attempted to exit positions at the same time. Decisions reversed rapidly, with investors withdrawing from these groups and avoiding similar trades after experiencing losses. The scam collapsed when investigation replaced assumption, exposing that price movements had been controlled rather than driven by real market demand. Once exposed, these stock group scams revealed a repeatable structure where coordination replaced genuine market demand and timing determined outcomes. Organizers controlled the entry and exit points, allowing them to benefit from price movement, while most participants reacted to signals rather than making independent decisions. Money moved based on group activity, and visible price increases created confidence that was not supported by underlying company value. The system expanded by repeating the same process across different stocks, relying on new participants to sustain each cycle. Investigation findings showed that simple coordination and information control were enough to influence prices in low-volume markets. Real-world outcomes followed, including financial losses, reduced trust in online trading communities, and increased regulatory attention. This model demonstrated how quickly markets can be influenced when large groups act on the same signals without verification. The lesson remains consistent. When price movement is driven by coordination rather than fundamentals, the opportunity itself becomes the scam.